Thanks again for joining, and let's kick things off. All right, so as we sometimes do when we, well, when you spend your life and career looking at data, you got to have some fun, right? You got to have some fun with it, especially in this day and age after the year we just had. So belief is what you do when there is no data, right? So how's the market? Well, I believe it's pretty good. Will my home sell in within 30 days? Well, I mean, I believe so. I don't know what the average is. I believe so. So we're better than that, guys. You're all better than that. So, that's part of what we're after here today. Without data, you're just another person with an opinion. It's another interesting one. One of my personal favorites, data is the new bacon, right? Who doesn't love bacon? Somebody once referred to bacon as a gateway meat, right? It's a gateway meat. If you start it, it'll lead you down a slippery slope to other meats. So I thought that was fun too. And then of course, I know I've used this one a couple times, but here we are, folks. We're drowning in information and yet we're still starving for wisdom. So you have my word. I will shower you in information over the next hour, but I will also be very deliberate to hopefully share just a little bit of wisdom and a few insights, based on kind of what we're seeing. All right, so enough with the fun stuff. Let's get a little bit serious. On the agenda, we'll of course talk the market, and we have that broken out into short and long-term trends. Then we're going to talk market segmentation. Then we're going to hop into some of our market reports and hopefully do a quick InfoSparks training. And we'll, of course, use InfoSparks to continue our market update. And then I did update some economic charts for you guys to just kind of take a look at where things stand with recovery, as seems like maybe we've turned a corner, vaccines rolling out. I understand Minnesota is doing better than most states, which is a good thing. So yeah, it seems like things have turned a little bit of a corner. So we'll take a look at that. And then of course, we will open it up for Q&A. Okay, so we still have these three, it's what I call meta trends, right? Or macro trends. And these are, well, yeah, I mean, these are pretty long-standing trends, but especially over the last year or so. In fact, it's almost over the last year to the day. I think, what was it, March 16th, where we had that executive order for the K-12 school closure. So yeah, we're going to talk about how that's changed, but you're correct that these are pretty long-running trends. These aren't necessarily new. These have been around a while, but things have become a little bit exacerbated, especially in terms of inventory. So we're going to talk about that. Okay, so first, buyer activity is strong. I bet all of you are familiar with this. 2020 was a record-breaking year for sales. And even though we saw that pullback in April and May, by June, July, especially August and September, we started to post records. Records going back to 2003, at least, very likely going back to at least 2000. So we're talking 20-year records, right? Pretty impressive. And then seller activity remains subdued, right? It's still pretty weak. New listing activity is quite weak. So looks like seller activity was up a meager 0.1%, and that's last year compared to 2019. But in December, we saw a 23% spike, and that kind of led some of us to believe that maybe January and February would deliver, would come with some additional listing activity. We were wrong on that, right? December 23% plus jump in seller activity, I wouldn't say it's a mirage, it happened, but it wasn't really a turning point in terms of our trend. Yeah, we do not see this widespread turnaround, even though we saw that strong December spike. So it's possible things could be changing. We are seeing some mixed signals. That said, February new listings were down 12.5%. Inventory, of course, this is the biggest factor holding back sales and frustrating buyers, right? The number of homes that we could write offers on is down 75% over 10 years, while sales and population levels have only increased. You guys can kind of see we're setting up, we have some interesting dynamics at play, and you'll see that sort of ripple throughout a lot of what we'll go through today. Okay, so the market, let's talk short-term trends. Well, excuse me, before we get into those, let's just keep setting the scene a little bit. So eventually, eventually buyers and the market could push back against rising prices. And some might be asking the question, could this kick off the next market cycle? Historically, in terms of Econ 101, right, rising prices should incentivize more supply, right? The folks who bought a home at 250 who can now sell it for 3.25, that should incentivize them to sell and maybe move up to a market that's a little bit more plentiful, a market that's better supplied, say, over 500,000, 5 to 7, especially over 6 or 7, just supply levels are better. So for now, homeowners are, of course, enjoying the ride up, and we're remodeling and we're staying put a little bit longer. It's like a game of musical chairs. If I give up my chair, where the heck will I go? So that's a legitimate question. And then the inventory shortage, does that become a self-fulfilling prophecy? So I won't list my home because there's nowhere to go. And there's nowhere to go because I and my neighbors won't list our homes. So it gets a little bit cyclical, a little bit circular, which of course is interesting, albeit not necessarily that positive for the market. So daily showing activity. This is one of our favorites, of course, because, let me get my laser going, because it allows us to compare 2019 here, and is that turquoise, maybe chartreuse? We did a little bit of a redesign. So I guess I'm still getting my color palette down. Our designer and kind of creative director, Ross, just does a phenomenal job with this stuff. So we are very grateful to him. So 2019 here in this greenish chartreuse turquoise color, 2020 in gray, and then 2021 in this sort of dark. Oh boy, plum, should we call this plum? Let's go with plum. Regardless of the labels of the colors, you guys can see, just what happened with 2020 showing activity, right? So 2020 here in gray, you guys can see the big dip, right? And sure enough, like clockwork, was it March 14th, 13th, 14th, 15th, whatever it was back then, and then you really see the decline. And look at how that compared to 2019, right? So we were saying here, oh my gosh, we're well below, will we ever make that up? And sure enough, look at how much we were hovering above 2019 levels, and we had no problem making up that showing activity, which was a leading indicator, kind of a hat tip tipping us off that we would have record sales. And sure enough, we did. And that's why looking at showings is such a great leading indicator, right? I like to say it's the thing that happens before the thing that happens before the thing, right? Before you close, you got to go under contract. Before you go under contract, well, most people, I suppose some buy homes in cash sight unseen, but it's a pretty small share, right? Before you write a contract, you probably have to go to a showing. Before you do that, you probably have to get pre-qualified. So one of the more powerful elements when it comes to forecasting or extrapolating is trying to get leading indicators, trying to get earlier and earlier in the process to give us a hint of what might be coming down the pipeline. Speaking of coming down the pipeline, I see showing activity this year remarkably strong, right? Remarkably strong. We're only in mid-March here, Pi Day. My wife and I bought some cheesecake on Pi Day. I think it was on sale somewhere, 3.14. You have to love Pi Day. I'm a religious Pi Day celebrator. So look, already guys, here we are mid-March. We're almost matching 2020 showings levels, right? We're really close. And look at how far ahead we are of 2020, even pre-pandemic. I like to call it in the BC era, before COVID, versus AC in the after COVID era. So, right, we're already pretty close to our highs in showings for 2020. And we know the second half, especially third quarter and fourth quarter, were remarkably strong. So a pretty encouraging sign. As we do every week, we want to break down showing activity, of course, by price point. So you guys will see down here, we have under 200K all the way up to 1 million plus as we get into our luxury segment. You guys will notice we've got the most recent week last year and then the most recent week this year, ending March 14th, both last year and this year. And then we can see where activity is down, right? It's pretty clear. Our most affordable segment, there just aren't as many listings to show. So of course, showings are down. And then we see some of that sort of redistributed in our, I would still call these our affordable price points, call them our sub 300, say our 2 to 300. We see some of that activity sort of moving into these categories. And then of course, don't discount the fact that we've seen pretty significant gains in, I think of this as a mid-market range. Yeah, as you start talking 4.25, you start to get into the move-up range. Over $500,000 definitely feels like a move-up range. And then, luxury is doing really well too. It's not just interest rates that are good for your regular buyers buying $300,000-$400,000 homes. Jumbo rates are also very friendly, very attractive as well. All right, let's shift into market share. So this kind of plate color represents the pie that I've eaten. And then this maybe pumpkin or sweet potato color is the pie I have not yet eaten. And how appropriate that we would celebrate pie near Pi Day on 3.14. Amazing. I swear we did not plan that. All right, showing activity. Instead of just a number, it's really useful to look at the percentage. What this is telling us is that last year, 23 of every 100 showings were on properties under 200,000. This year, only 17 out of every 100 showings were occurred on listings under 200K. Pretty flat here. This is kind of interesting. Dead even, 23, just about dead even, 23%. So just under 1 in 4 showings occurred on properties priced between $250,000 and 300K. We won't go through all of these, but this looks like a pretty significant boost to me. What is that? More than a 33% jump in market share from 10 to 13. Million plus also doing pretty well. So it's really just our affordable segment, and I guess it's the under 250 segment where we see a decrease in showing activity. All right, so another way to look at this, you guys, is instead of just looking at the number or the percent, let's look at the change. Where are things growing or versus contracting? Well, we don't have to beat this dead horse that much, but here's your under 200K down 10% in terms of showings. Don't forget, overall, showings are up about 22%. And apologies, guys, I like to color this a different color. It looks like I missed this one just to make it, it's not another price range, it's just the total. So I meant to set that off visually. Where's our biggest gainer? 86% increase in 1 million plus showings. 86% increase, nearly doubling. Now, I like to say, I always like to give a caveat, and let's just think this through. If I had 10 showings, right? If I had 10 showings last year and I had 18 showings this year, right? That's an 80% increase, but we're only talking 8 more, right? From 10 to 18. So just know that this is a fairly thin segment with not, doesn't have a ton of activity, definitely a growing amount of activity, but just know that sometimes the percent change can look extreme because it's what we call small sample size. There can be thin records, thin activity in here. All right, these next two are some of my favorites. I just love the way they line up the last 4 years and kind of compare the trend over those 4 years. So we've got 2018 in our, here we go again, in our dark turquoise, maybe 2019 in gray, 20 in orange, and then 2021 in our kind of dark blue here. Oh gosh, where to begin? It looks like, look at 2018 and 19, right? These were fairly normal years. They sort of follow each other over time, right? Which is pretty interesting. Of course, 2020 was a unique year, a different one. But look at what was happening with listing activity last year in the BC era, right? In the before COVID era. Things are pretty strong, and then enter COVID and we saw this dip, right? Similar like what we saw with showings, and we'll show something similar with pendings as well. Again, we kind of made it back, but we weren't able to show any kind of gain. I think we had just 0.1% last year, so just very, very small. It just wasn't enough to move the dial. And then, I really wish I had better news for you guys, but if you look at this 2021 trend here, yeah, it looks like we're just about in last place in terms of new listing volume compared to the prior 3 years. So of the last 4 years, 2021 is pretty sluggish in terms of seller activity. And that's exactly what we don't need, because look at the demand side of our equation. Look at the pending sales side, right? 2021 has been well ahead of the prior 3 years, right, for a long time. I suppose things were a little different there. You know what? If you really want to geek out on this stuff, you guys, we can really start splitting hairs. But you guys can see technically now, yeah. So demand for, I guess, for the most recent week period here, demand is running ahead of the prior 3 years. So it's just about the strongest in 4 years, as it had been, in the first couple months of the year, through just about Feb, and maybe we had a little bit of a dip here. All right, let's zoom back out. When in doubt, zoom out. So yeah, that's pending sales. And again, you guys can kind of see the COVID impact there. And then here we are getting all the way back. Now, don't forget our first showings chart. You guys will remember showings took this same hit and then got well above the previous years, right? Kind of like what we're seeing here in orange in 2020. And so that was, again, that was a great leading indicator for what was coming down the pipeline in terms of actual signed contracts, actual accepted purchase agreements. All right, so change in new listings, overall down 33% for the most recent week. 1 million plus, only down 4.5%. Some of our more affordable ranges down almost 50%, right? So we are still very thirsty for supply, and it just doesn't look like we're getting it, at least not recently, not for the most recent periods. All right, here we go. I did a little bit better here with our total, kind of denoting that, setting that off a little bit visually. Change in pending sales. We're over on the pending side. So simply an accepted offer, signed PA, however you guys want to think about it. Sales activity down in our most affordable ranges. I bet you guys are noticing a pattern. I bet you guys are noticing a pattern. So slowdown in activity in our most affordable ranges, nearly a 7% jump in between 250 and 350K, which is nice. I'd call this flat or down 1 or 2% in 350 up to $500,000. And then as we get into our luxury segments, you guys can see, you can really see what's happening. Luxury is a growth market. We've absolutely seen that happen. Those with the wherewithal to swim in that pond and to play in that sandbox, it's not a dirty word, high net worth individuals, they're doing fairly well, and they weren't really impacted by COVID the way so many others were. All right, now let's shift gears into some of our longer term trends. So this is monthly data now. This is monthly. This is February. These numbers just went out to the media yesterday. We had our monthly press release yesterday. So this is very fresh, very crisp and fresh data. All right, so new listings by price point. See a continuation of our trend here, down 41%. Seller activity was down 41% between 120 and 150K. Nice to squeeze out just barely a gain, right? A little under 1%, 0.7% in our very popular range, 250 to 350. Now, I say that's a popular range. I mean, you guys know that. I think we all know that. But one of the reasons is, of course, our median price is what, about 310, just over 3. So, of course, there's a lot of activity on either side of that 310 mark. And yeah, new listings down a little bit, million plus, although up for 0.75 mil, up to $1 mil. Change in pendings. Golly, kind of seeing the same trend, huh? Decline in purchase agreements under 190, right, under about 200K. And then we see the gains growing as we climb the price ladder. Once again, and guys, this is February, as a whole. This is the entire month, not just 1 week. Sometimes 1 week can be wonky. Was it cold? Was it a nice, a nice weekend where we hit, 60 plus and everyone's out? But yeah, we do see really strong gains in those luxury segments. Okay, so now we're looking at February new listings, and this is every February going back to 03. So Feb of 03, right? Feb of 06, Feb of 2012, and now Feb 2021. Where should we begin? You guys can kind of see our high water mark during the good old bubble years, right? 06, 07, 08. We saw seller activity come down, a little bit of a wave there. And now, right, we already saw we're down about 12.5% to about 4,700 new listings during the month. I suppose it's worth noting that that's not our floor. That's not as low as we've ever been, but it's obviously lower than we'd like to be. And you guys can kind of see, okay, although it's been up and down, it's been pretty flat overall. And we're going to see next that demand is really on the rise, and that's pretty clear to see. So this is pendings, this is signed contracts only for February of every year back to '03. Golly, what was going on here? 2005, a lot of signed contract activity. Did they all close? I'll give you a hint. The answer is no. We're going to see that. So keep in mind that February of '05 figure, kind of a pie in the sky. You know, we've seen gains, we've seen nice growth, and this is a good thing. You know, one theme that we're going to talk about a little bit more is, how do I say this well? Although sales are still growing, it looks like the year-over-year rate of change is decelerating. And I don't mean that sales are declining. I mean the rate of growth is decelerating, right? So you're driving down the freeway at 70 miles an hour, then you decelerate to 60, right? You're still moving forward, right? You're still adding mileage, you're still adding speed and moving places, but it's not at the same rate that you were. It's a different rate of speed. So we're starting to see, you know, plus a tenth, plus 0.2% increase in pendings, signed contracts. Although we saw what 17, 20, 25% gains, maybe 6-8 months ago after COVID. So now check out closing. So right, Feb '05 and even later, we don't see that pie in the sky. So no, not all of those closed. Now it's not that every pending sale in February closes in February. In fact, it's usually March or April, whatever the average is, 30, 45 day, 60-day close. So it's not one-to-one, but just know that closed sales are kind of the real measure of demand on listings that have actually closed and gone off market, versus under contracts where there's a contingency that might get triggered, or maybe a buyer kind of slithers out of the deal based on inspection, kind of gets cold feet. A couple of you have mentioned that that's a thing that's happening. And then appraisals. We were talking about appraisals the other day with another group. Personally, I'm not hearing that they're a major issue, but I'm also hearing that you guys are putting in the contracts a clause that says, should this not appraise, the buyer agrees to come up with the cash difference before hitting the closing table. So that's interesting. Right, you guys, 3227, 3230. That is the highest closed sales figure we've had for any February of any year going back to '03. I feel pretty confident saying that that's a record going back to 2000, right? I'd say I feel 98% confident saying that, but I'm not 100% because our North Star data only goes back to '03. All right, market times, median days on market. 19.5 days, my friends. This is a pretty fast moving market, right? I don't have to tell you guys that. I think you all know that. You live and breathe it. So 19.5 days, okay, call it 20 days, heck, call it 21 days, so 3 weeks. Now, what do we know about a median? It's halfway, 50% above. The other half sold in less time or fewer days. So, even though we have 19.5, listen, we know some listings go off market in 4 hours, right? 8 hours. And we also know there's some $2-3 million listings or above that can linger on the market for 100 days, 300 days. I think a couple of years ago, we even saw 6, 7, maybe an 800 days on market. They just didn't take it off. So yeah, 19.5 days. Homes are selling in half the time, guys, 40 down to about 20, right? That's a 51% decline. Pretty remarkable, and really remarkable when you think about 140, even 120, or even 100. Really a big difference there. Alrighty, so median sales price. Let's talk money. Everybody likes to talk about money. Price is up 11.5% from last February. So here's our February price, up 11.5%. God, do I love this. 3.14. You can't make this up, you guys. It's just a pie day, a pie month. Well, almost a pie day. 3.14, I love it. 314,000, up 11.5% from 280 last February. And you guys can see well above our, call it 2.25, roughly 225, which was our previous high point for February. I suppose I should say our previous high point, since 2017. I should say, once we hit 2018, we were above that, but prior to 2018, that was kind of our high point. So you guys can see how that looks. Alrighty, year-over-year change in median sales price. It's nice to look at Feb over Feb over Feb because we have a seasonal market. We live in a beautiful, beautiful winter state. Please don't throw virtual tomatoes at me, but I was kind of hoping for more snow so I can ski it at Afton just a few more times, but don't get mad at me for wishing that. Instead of just looking at Feb over Feb over Feb, the beauty of this is that we're looking at the change for every month. So it allows us to track more detail and possibly spot, more trends or different trends a little bit more quickly. So check it out. As we came out of that Great Recession, right, 08, 09, as we started to exit recession in 11 and 12, look at what we saw in those early days of recovery, 18% year over year gains in home prices, 18%. A lot of flippers, a lot of foreclosures, a lot of competition, a lot of multiples over, $150,000 foreclosures, you name it. And then we kind of settled into, I don't know, 4 to 6, 5 to 7, what have you. And then we see, things are elevated now, right? You guys can see this. So we're about 12.5%. We can see we're elevated. We were a little elevated here. So you guys can kind of see these moments, these historical moments of above average price growth. Okay, fine. Let's do our Jeff Bezos joke, right? Median versus average. I think we actually did a video on this, and we actually got some hits out of it. All right, so Mr. Bezos walks into a bar, right? This is the annual income for the 6 people sitting at the bar, assuming you can have 6 people sitting at a bar nowadays. And then in walks Jeff with his 200 million, right? What's the average income for this group? It's $28.6 million a year, right? $28.5 million a year. Is that a good representation of this group? Or would you prefer the median of 65,000 a year? Why is that the median? Because half were over that 65,000 and the other half were below that 65,000. I'm going to climb out on the skinny branches and say, this is a better measure of this data set, right? Now, just because we're having so much fun, let's just be ridiculous. And this is, well, is it ridiculous? This is probably more accurate. So now we have 200 billion, and maybe that's not his annual earnings, but maybe it's probably not far off from his wealth. I don't know, maybe he's at $1 trillion. I think it's not that much. So now the average income for this group is 28.6 billion, right? Remember, previously it was million, but we added on 3 more zeros, right? So now it's billion, and the median has not changed by 1 cent. Didn't have to, right? It's still that midpoint where half people are earning over that median, the other half of the people are earning below that median. Now, this is not just fun and games, my friends. This is not just jokes. This is real, right? So here you have the sales prices of 1, 2, 3, 4, 5, 6 properties, right? Now, the average here again is 833K. Why? It is pulled upward by this outlier, right? It is pulled by this anomaly. It has a lot of influence on the average. The median, 312.5. Why? Because we have an even number, we have to split the difference between the 2 middles, right? So we split the difference between these 2, and then you've still got 2 above and 2 below. So, again, this is why we like median. This is why we prefer the median. And I think you guys get that. PPSF, price per square foot. This is simply price, total sold price divided by TFSF, total finished square footage. Doesn't matter to me if all your square footage is above grade or if you only have 1,200 above and, I don't know, 1,800 below. Doesn't matter. Total finished square footage. About $170 per foot, $169 per square foot of house, up 12%. When's the last time we had that kind of growth? Looks like we got to go back to 2014 for that. The last time we saw 12% plus growth. So again, we see price growth accelerating, right? 7, 9, 5, 7, and now we're suddenly at 12. So pretty strong turnout there, pretty strong showing. Okay, another one of my favorite indicators. It's hard to pick a favorite. I love them all equally, right? It's like picking a favorite child. I really like what days on market, month supply, and this ratio of sold to list price tells us. It tells us things that we can't necessarily see, otherwise or elsewhere. So this is our percentage of original list price received at sale. Now, remember, this is original. This is before any price adjustments, before any kind of reductions. Maybe you're at 309 or 314.9 and you want to try out 299 on for size and see if you show up in more searches that are up to 300. And so this is really that original. And what's so amazing, what's so remarkable about this being original is that it's over 100% of original, not just current list price, but original. That's well above where we were during this 03 to 06 period, right? 98% is still a really strong figure. 88% when we were coming out of the Great Recession, not so much, right? This is where sellers had to basically give a 12% off coupon, right? A 12% discount from their, 100% original asking price. So this is really fascinating. Oh gosh, this is fascinating for so many reasons, but I'll be quick because I have lots more charts for you guys. We saw things flattening out, right? 98, 97.7, 98, we were kind of flattening out, and then something happened, and we can really see sort of the COVID signature, where we see a lot of competition over a shrinking pool of homes, over a limited supply of listings. Speaking of a limited supply of listings, here's our happy chart for the day. It's not that happy. Inventory, 31,500 in Feb of 08. Can you believe that? 31,000 homes listed under active status. Last month, 4,700. 4,700, down 46%. Yeah, we have a supply crisis, right? We do not have enough homes to meet our demand. We simply don't have the supply to fuel all this demand. People are buying up all the nuts and bolts in the hardware store, and the storekeeper is just not refilling those bins. We're just not seeing the bins being refilled. That, of course, trickles through to our month supply of inventory metric, also known as an absorption rate. Same thing, synonymous. What we're shooting for here, historically, some say, the scholarly literature, and I'm making air quotes even though you can't see me, the scholarly literature historically has said 5 to 6 months is considered balanced. With technology and the interwebs and everything, some say maybe 4 to 5. I think I like to say 4 to 6 is pretty balanced, but the reality is, if you're between, 4.5 to 6.5, or even 4 to 7, you're relatively balanced. Where are we at today? Right. 9/10 of a month of supply, 0.9 months of supply, right? We were a tight market here, right? 1.5 to 2 months of supply. This was a ridiculously tight market. Now, it's just absurd, right? Less than 1 month of supply. This is really something. And, sellers understand that their position is pretty strong in this kind of market. Right? They don't have to accept lowball offers. They haven't had to for years, right? Look, if you're going to offer me even 98% of my asking, I probably have 103% waiting in the wings, and it might be all cash, right? So it's a pretty remarkable time. I'm going to fly through these pretty quickly. Let's do a time check, about 2:35. So let me fly through some of these a little bit more quickly. And you know what? Before I do that, let me just check. Okay. What is the difference? Data pulled. Yes. Okay. So Christine has a good question. Yes, it's a great point. So 2005, some of those signed contracts were condos, right? That either didn't come to fruition or didn't close, or for a variety of reasons. And then, hey, look, my friend Bill's on here. Hey, Bill. What did shade shift represent on shade? Oh, I think that was just the design. Forgive me. I should simplify that. Apologies, didn't mean for that to be confusing. So just thinking through supply and demand here, we talk a lot about sellers markets with less than 5 months supply of inventory. You got a lot of buyers competing over only one home. A buyer's market, you've got 2 buyers, but you've got 3 listings. Essentially, these sellers have to compete for these buyers. And in order to do so, they tend to have more price reductions, right? They tend to do more seller paid closing costs. They tend to, kind of sweeten the deal a little bit. Maybe I'll replace the water heater, if it's old, whatever. Your buyers aren't getting sellers to do a lot of that work now. I know there's still some seller pays, there's still some concessions, and still some fixes that come out of inspection, but far less, I should say, you see far less of that here than you would here, right? In a buyer's market where the buyers are empowered and in control, holding the reins, you see sellers having to make these concessions for the buyers. What we're shooting for is simply a balanced market. Is that asking so much? We're looking for that 4 to 6 months of supply. You've got 4 units of demand pretty well matched up with 4 units of supply. All right, my friends, let's talk affordability. And we've got our affordability dogs who are ready to take some deep dives with us here. Okie dokie, so here we've noted our recession 07-09. We've got our Twin Cities region here, Minneapolis here in gray, and then St. Paul here in dark blue here. We're looking at the percentage of actives that are under 250,000, right? And we're using our rolling 12-month average. So at one point, right, 83%, well, maybe I'll go with the metro, 62% of metro-wide actives were under 250,000, 16, 17 years ago. Notice how that went down as prices rose into the bubble, and then here's our recession, and we see that figure going back up as prices softened, right? So then 70% of actives metro-wide were at or below that 250,000 mark. Now, take the giant slide down, right? Like we say, a disappearing act. Now only 23%. So it used to be 7 of 10. Now it's barely over 2 out of 10. That's, I don't know. Some of you might be shocked by that. Some of you might not be. Look at St. Paul though. They've flattened out. They've managed to preserve a little bit of their affordability, which is a good thing. By the way, St. Paul, it's a lovely suburb just to the east of Minneapolis. I think you guys would find it lovely. Okay, so how about this one? Percentage of pre-tax income spent on the mortgage of our median priced home. So let's say that again. What percent of my pre-tax income, if I'm a median earner, what percent of my pre-tax income do I spend on my mortgage if my home is a median priced home, a typical home? Used to be 25% of my pre-tax income I spent on housing. If I were to purchase the median priced home back then, I'd spend 25% on housing. Lately, 18 to 20%, right? 18.5%. Here's how the math works out. Income, household income, 103 grand. Percent to housing, 18.6%. That's 19,000, call it 19,300 bucks a year. And that works out to just about 1,600 bucks a month. And that is on your median priced home. So that's on a roughly, what, 300K home? Because remember, this is a 2020 number. So I know now we're at 310 or 315, but over the whole course of last year, I think we were about 305. Now here we are. So here's that 1,606 figure. Look at what the payment used to be, even though, so this is what I think people are surprised by. And it's a little bit wonky to wrap our heads around, but this is your monthly PITI payment, your all-in payment on that median priced home. Yes, we make some assumptions here. We're using that current 30-year fixed rate. We are assuming 10% down. Some folks get to 20, some folks get to 2.5 or 3, or depending FHA or conventional or VA or 203K or what have you. And then we're assuming a 1.2% tax rate and a 0.5% insurance rate, which, we did some testing and these are actually pretty good numbers. So even though prices are up here since 06, look, payments are, for all intents and purposes, right, are pretty much flat, but technically they're a little lower. What are they? $16 a month lower, right? 1622 versus 1606. How could this be possible? Interest rates, right? Interest rates. We're going to look at it in just a second. This one shows price to income ratio. So very simply, here's our $305,000 median home price. Here's our same 103,000, 103,500 median family income. So the math is pretty simple, you guys. It's about 3 to 1, right? We have to go out and spend 3 times our incomes to get this house, to get that median priced home. Yeah, so about 3 times. You guys will notice that is about at 05 levels. Now, is that concerning? Maybe. Let's keep going though. We'll revisit that in just a second. So here's where I have both plotted, right? So I've got our PITI payment here corresponding to this axis. Then I've got our median home price here corresponding to our right axis. Notice how price in our turquoise here, notice how price 230 versus 305, well above. Notice payment, like we just saw, flat or even down slightly. Look at the gap between payment and price here. Look at the gap between payment and price here. Now we talk about 3-to-1. Is that really concerning? Maybe it seems high. I don't know. Maybe not. Minneapolis, here we are, 2.9, just about 3-to-1. What about our friends in the Bay Area? What about our friends in San Francisco working for Uber and Twitter and, I don't know, Apple and Google and whoever, Tesla, I don't know, SpaceX, whoever. You know, those guys have to spend 11 times their incomes, right? Median home price hits a new high, 1.6 million. Half of the sales in the Bay are over 1.6 million, the other half below 1.6 million. For us, it's 305,000, half above, half below. So those guys in the Bay Area, sure, they're earning more than we are. They're earning 143 as their median family income. Here we are, about 103 and a half. But instead of spending, you know, so that means their home price could be what, about 40% higher because their incomes are about 40% higher? Huh, dream on, pal. You're talking about 11 or 12 times our incomes. You guys can see, you know, some other cities that we compete with for labor, talent, corporate relocation, federal funding, transit dollars, light rail dollars, education dollars, whatever. A lot of these different cities, you know, we compete with, you know, New York and Chicago and LA, you know, a little bit, maybe call those first tier cities. Maybe we're more like a second tier. I know, it kills me too. But you think about the Denvers, the Phoenixes, the Atlantas, Charlottes, and Bostons, you know, those guys are between 4 to 6 or even, you know, 5 to 7-ish. So just keep this in mind. I know 3 seems high, especially when you see that, you know, wow, okay, well, that was what we were at before. But when you think about what other metros, other regions have done, I actually think we're doing pretty well. Okay, so let's just have some fun with this. Median condo. All right, so 1.2 million. So what is that price per square foot? Condo, average condo. Okay, so 1,000, so 1,100. All right, 1,100, call it, well, okay, let's be generous. Call that $1,000 per square foot. You guys just saw what we're at. What was it, 169, 170 per foot? Let's be generous, call it $1,000 per foot, right? That means that this is what I own. I own a 2,000 square foot Bloomington Rambler built in 1958. I think it's probably worth maybe 3.25-ish, right? If I move that to the Bay, that would be a $2 million house. A 2,000 square foot Richfield or Bloomington or Plymouth, you know, Brooklyn, you know, Crystal, whatever, these Ramblers, you know, lovely old solid homes. They would be priced around 2 million if we had Bay Area prices. Okay, quick time check, about 2:45. Okay, so let's fly through a few more of these. So this is our long-term trend. This one goes all the way back to 1960. You guys will see in our green here, this is our actual recorded average sales price. You guys can absolutely see the bubble in 05-06, followed by the downturn. I like to say this was our party. This was our hangover when we had to kind of pay some of it back. And you guys will notice, look at this channel, right? This is our average growth rate. So if we had steady Eddie growth every year, year in and year out, the same consistent growth, we would kind of remain in this channel, right? Because we were above our channel, we had to be a little bit below our channel. In fact, we're still below our channel. This was an overvalued market, right? We were well above our channel, our average growth rate. Now we're still a little bit below. I believe that means we have some room to run. I also think that does not support us being in a bubble, right? Back here, it was a supply-driven bubble. There were so many listings, 30,000 plus. If you could fog a mirror, you can get a mortgage, and then it all kind of went south. Now we have a demand-driven market where there just isn't enough supply to satisfy that demand. Let's skip this one and just go to this one here. You guys can see this long-term trend. New listings up top in our turquoise, closed sales down below in our plum, like that. So take a peek, heading into 05-06, look at what happened with new listings. Supply-driven bubble, right? But look at our demand indicator. When demand fell off and supply was still really high, all these sellers had to make concessions, or they went into foreclosure, or, you know, whatever. And don't forget, a lot of the plugs were pulled on these projects that were half built, some of these condos that were halfway in the ground. So, look at the gap here, you guys, a huge gap between our supply and demand indicator. What do you see now? Almost no gap, a much, much tighter market. So that kind of paints the picture. Let's just do one quick word on Minneapolis. I know some of you have been following this one closely. So have we. Some concerns about the events last year, and oh gosh, reading articles like that use phrases like urban exodus, are people fleeing the cities? Well, we did see a 14% increase in new listings, but we saw a 40% increase in pending sales in Minneapolis, right? That was our second highest figure, outside of, it was our strongest month. Oh gosh, forgive me, you guys. I think I'm still on January. Forgive me. I should have updated that to February. That's my mistake. Actually, you know what? I may have a clever way of showing that to you guys anyway, but February was similarly strong. I don't think it was quite 40%, but demand rose much more than supply. Buyer activity was up more than seller activity. People are eager to live in the cities. It has not changed. It might have had a disruption. Some folks might have needed some more room for homeschooling and homework and everything. And that's fine, right? But a lot of these first timers who saw maybe condo prices come down, 10 or 20 or 30K on a $300,000 condo, some of those folks see that as an incentive. And with rates under 3%, or I think right now at 3.09, they're seeing opportunity there. And sure enough, they're going out and grabbing the carrot. So let's sum that up. Minneapolis new listings are their highest since 2014. However, pending sales in Minneapolis are at their highest level since 2005. Our demand record is a much longer standing record than our new listing record. All right, let's spend just 30 seconds talking luxury, right? It looks luxury. I can't say I've ever seen a khaki colored Lamborghini, but then again, I don't think I've seen many Lamborghinis. Luxury upswing, luxury market best week, pandemic boosts luxury. Houston luxury homes skyrocket. Hawaii luxury homes jump 26%. Luxury, 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 right? So look at closed sales above $1 million. This is in our metro area, right? 25%. That's a big gain, especially our previous high was 31. How about for all of last year? So this is 2020. This is December year to date, meaning it's an annual figure, right? It's a yearly figure. 20% gain. Right, up to 920, just about, which is almost double the previous high in 05, 05, 07, call it 05. So really a remarkable figure here. Here's another interesting time, right? You guys remember that tax bill in 2017? I think the Republican-led legislature did that tax bill, and I think, don't quote me, I think I remember reading, I think 83% of the benefit of that tax reform went to the top 1% of earners. Now that has some pluses and minuses, and we're not here to debate that. But that led to an unleashing of capital into luxury real estate. So we see a pretty big gain there. Okay, let's pivot a little bit. Let's talk market reports. Before we do that, I want to spend just a second talking applications. How do I use this stuff? Oh, don't we all miss that? You guys get a lot of questions. Am I in a buyer's market or a seller's market? We have months supply of inventory to answer those questions. You get asked, how do the different property types compare? I want to be in this school district, but I'm thinking a townhome or maybe single family, but talk to me about how they compare. Prices, are we up or down, right? Median sales price, average sales price, price per square foot, a lot of different metrics there. Listen, Mr. or Mrs. Agent, I know you say it's a hot market and yada, 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 but how long will it actually take me to sell my home? Well, in St. Louis Park for three bed, 2-bath homes that are 1,850 square feet, it's about, well, now probably 16 days. Maybe a couple of years ago, it was 30 days. What's happening with new construction, right? When do I have a lot, more inventory? What's happening with foreclosures and short sales, right? You guys get to be the expert that you wish to see in the market. So don't forget to channel your inner Gandhi. So how will this benefit you guys? Listing presentations, right? You get to sound smarter. You get to bring the facts to what is often an emotionally charged process. Open houses, showings, don't overlook some of the simple stuff. Prospecting, you're talking about lead gen, lead capture. How about personal marketing? This is one of my favorites, right? It's me versus the market. The average market time in Edina is 33 days, but my market time in Edina is 22, right? So that's why you should go with me, because I can prove that I outperform the market, right? That's a way, that's one way to look at that. Here's another powerful one. How about when it comes to managing expectations by getting everyone on the same page with, the reality, the market realities? More strategic, informed decision making, better ability to forecast and extrapolate, which really, helps you guys with business planning when you think about GCI and dollar volume and all that fun stuff. This obviously helps that too. And don't forget growth opportunities, right? We already saw 1 million plus as a growth opportunity. We have seen the suburbs, see more demand. We've also seen the urban core experience higher demand. Again, after a little bit of a disruption last summer. New construction, very much a growth segment. 1 million plus, a growth segment. So it allows you to kind of think about that and look at that. Before we do any economic stuff, I want to take you guys through just some of our market reports. We may have some new folks on the call here. So I just want to make sure everyone knows. So before we get to InfoSparks, and we're going to have a fairly truncated little session here, I want you guys to know right from our homepage, mplsrealtor.com, you guys will see all of our major reports here. You can also access it from our market data section here. I'm just going to click on local market updates, right? And here we have our Fast Stats portal. A lot of folks will choose to just bookmark this, right? Put it in this folder. A lot of folks choose to bookmark it, and then you can just, kind of go there, right? Fast Stats. So we've got our locals, our weekly, our monthly, our annual report. Let's just hop into one of our locals. Let's go Hennepin County. Who should we pick on? Yeah, let's do Richfield. Why not? Right, we should have Feb up. So this will be February numbers this afternoon. So do check back. But median sales price, $295, all right, up 10 1/3%. Closed sales up almost 40%. Of course, new listings down about 10%, but we're only talking 4 less, right? From 36 to 32. Half a month of supply, right? 0.6 months of supply. I don't know what else to say about that. We're starting to measure absorption rates in weeks. We have about 2 weeks, 2.25 weeks of supply. Sellers getting 102% of their original list price. Again, a really strong figure. So we really encourage you guys to play around with this. Of course, every city, every neighborhood, every community is going to be different, right? North Loop is going to be different, right? So a little bit more absorption rates. How about days on market? Market times on the rise in the North Loop, right? 122 days. Interesting. How about prices? Prices a little bit softer, right? This is a different market. This is a different area. This has different product types than Richfield or Lakeville or Champlin, whatever. So again, really encourage you guys to check that out. All right, InfoSparks. We got 3 minutes, you guys. Let's see what we can do. And we might have to skip our economic update, but we'll do it. We'll do it next time, I promise. So right here, you guys will see you can choose your area. I just tend to start typing EDIN, and then you'll see what you want, or EDEN, and then you'll start to see your district and your city. And then you have your metrics. What do you want to look at? Days on market. You want to look at prices, money. You want to look at absorption rates like we were playing around with, 1.6 months. However, for just for just February, there's our 0.9. All right, we used to have 11 months of supply when we were oversupplied back here. And then choose your breakout. So choose your area, choose your metric, and choose your, I think of this market segment. You want to segment it out, choose your brackets, your price brackets, choose your construction types, what have you. So, let me go back to my rolling 12 month and let me just do a quick construction type breakout. 1.5 months supply of existing, about 4 months supply of new construction. But look at the new construction trend, right? Used to have 6 months of supply. It has shrunk pretty quickly down to 4 months. How about the prices on these different products? Existing homes, about 300,000, new, just about 410, 412. All right, let's do one more here. Let's just do property types. Actually, this is the big one that we should do. All right, so prices, condos, we can already see little softening here, down about 1%. Nothing to write home about, but our other segments are rising at a decent clip, right? We can see in red, we can see condo prices flattening out just a little bit, right? It's pretty clear to see. How about market times? Wow, check this out, you guys. Notice how townhome days on market, right, down 14% in green, single family market times down 1/3 in blue, condo market times up 7.5% in red. And you can see the divergence, right? We can absolutely see the divergence. Speaking of divergence, let's just do month supply. This is the big one. This is the big one, right? Look at what happened with condo absorption rates here. Everything else is heading down, heading south, becoming a tighter market. Condo market became a little bit more of a balanced market. It's still a seller's market, right? Less than 4 or 5 months of supply. Maybe I should say fewer than 4 or 5. Well, anyway. Right, so look at this change. And if you want to zoom in on that, let's just look at the last maybe 3 years. Look at this change, you guys. It's pretty clear. I think there's a song that goes, "There's something happening here," right? So it's pretty clear to see. And then let's just do one more, percentage of original list price. Let's just see if we can spot some of these changes. Some of these shifts between the different market segments. This is really important to kind of understand and be able to show and illustrate. So I think this is just remarkably powerful. Let me maximize this and look at condos. Yes, condo sellers are getting slightly weaker offers. They're accepting a slightly lesser share of their original price. Notice townhomes and single family in blue and green, pretty flat, right? Condos softening a little bit. However, when did that start? You know what? Let's shut these two down. When did we see condos starting to change? July of 2019 into August, right? Into October, into November a little bit, right? So this is pre-COVID. This is the BC era, the before COVID era, where we saw things softening a little bit in the condo segment. So yes, I think COVID has exacerbated some of the softening we've seen in our condo segment. However, COVID was clearly not the only or the first cause of a softening in our condo market. So those are the facts, right? Like it or not, we did start to see some of these changes well before COVID hit us. So pretty interesting. Let's see, you guys, time check. All right, we're 1 minute over. Let's see if we can do one more. You know what? Let's do prices. This is an important one. So instead of filtering down to some of these different segments like I'm doing here, right, and here and here, I want to actually break out my different price points. So I'm going to click on my little splitter arrow. And you know what? Before that even thinks, I'm going to create my own ranges. So instead of my, see if I can do my little cursor flasher. Instead of my breakout here, I'm clicking on my custom button here. So I'm going to go, 0 to 300. Let's go 300 to 499. Let's go $500,000 up to $1 million, and then let's go 1 million plus. So look, before I say done, notice our ranges over here are going to change. And there you have it, right? They changed because we just did our own custom ranges. Okay, so now let's break things out. Let's take a peek at these sort of one by one here individually. Okay, no shocker there, 1 million plus sellers getting about 95, 96% versus 100% in some of our more affordable ranges. How about absorption rates? And you know what, guys? Well, let's just pause and geek out on this for a second. 33 months of supply for 1 million plus, 11 years ago? Pretty remarkable figure. Now we're down to 8.7. For this one though, you know what? I'm going to switch to bar charts. The trend lines are great, but the bar charts just sort of illustrate, it's just a different lens to look through. All right, under 300K, 1.1 months of supply, no shocker. 1.7, 3.2, and then here's our 8.7 for million plus. Look at days on market. 100 days down to 80, down to 70. So they are selling more quickly. How about sales? How about just plain old demand? All right, so not quite our biggest gainer, but a 27% increase, right? From a little under 800 to a little over 1,000. Looks like 500,000 up to 1,000,000 was our biggest gainer, even though, you know, our biggest segment in terms of volume is of course under 300K, followed by our 300K up to 500,000. And you guys can see as this steps down, properties age out of this cohort and into this next price cohort. So just something to be aware of. Yeah, we already kind of saw that 100%, 100%, 99, 95. There's just so much we can learn from this tool. I could go on for hours, but I'll spare you guys. I just really encourage you to kind of play around with it, get some mileage, get some flight hours behind the controls here. And I know that you're going to find just so much value here. You know, let's just go back to market times. I'll just show you guys, you know, a quick share. Sometimes I move fast and sometimes the internet can be slow. So I just want to make sure I click share and then I'll click live here and I'll just kind of leave this all and I'll say share and I'm going to click view in a new window. And now this is branded to me, right? It's branded to me. It's got my contact info. This will have your contact info because you'll be signed in over here, right? You'll be signed in. So this will be your info. Now, imagine sending this to a buyer or a seller, right? In a way that lets them interact with the data and really see it in a transparent way. There are no secrets. There are no smoky backroom handshake deals in the good old club, right? It's not how things happen. They get the data. You are being transparent. They see the same things you see, well, mostly. And it's a really powerful way of, you know, making sure your clients have a seat at the table, making sure they feel invited and part of the process, right? It's their process. You guys are helping them. So I think there's really a lot of power there. Email, Pinterest, right? The Bookface, the Tweeterverse, whatever you guys want to use. There's a lot of these. Just know whatever you guys use, it's very likely here. Of course, with the one exception of Instagram, and I actually wrote them an email and I haven't heard back, so maybe I'll follow up. You know, they go from Instapaper to iOrbix and then to Jappy Ticker. I don't know what these things are. But just know there's a lot of different options. So, you know, please do use the tool, love the data, use the data, share the data. And I should say with that, I will stop in the name of love and open it up to Q&A. I don't see a ton. Steve's a big fan of what we do. Well, I'm a big fan of you, Steve. All right, you guys must be feeling pretty good. Nothing?
There's something that Jeff said. So what is the condo market telling us? But you might have answered that throughout the presentation.
To pending versus condo. Yeah, I think we addressed that a little bit with some of the changes that we've seen in condos. You know, yeah, let's just riff on that for one more minute if this is something that people are passionate about. Let's see. Okay, so we've got our 3 breakouts here. You know what, you guys, I know we're doing Twin Cities region. Let's zoom into Minneapolis, where, you know, that has that hosts a disproportionate share of condos. All right, so we can already see, you know, market times creeping up a little bit as we saw. So that's median. What about average? I know average is almost always higher, and there you have it, right? 61 days versus a median of, you know, just about 40. But I think month supply here, I think we're going to see, this is where you'll see condos. Yes, look at this, you guys. You can't make this up. I mean, if this isn't screaming to you, something's changing here, you know, then you got to sharpen up some skills. This is telling us something's changing. And even townhomes, this is telling us something's changing as well, right? Single family, this is telling us that this is still a tightening market. This is still a hot, by far the hottest market, right? And getting hotter, getting tighter. Yes, I mean, a 70% from 2.7 months to 4.6 months is really a remarkable change. And, you know, here again, let's switch back to our line charts. And I think already you guys can, you can kind of get a sense for what going after here, yeah, you can really see these changes in the condo segment. And, by the way, let's hop over to probably the second largest host to condos. Same deal, up 78% to 4.1. I mean, it is almost a mirror image, which is kind of interesting, but maybe not surprising. Look at our red line. I mean, it's just done a hockey stick while our other segments are fairly flat or down. I suppose townhomes up a little bit, but I guess I'm talking more the trend here. Yeah, just look at condos in red. It's screaming to us that something's changing. The price is still up a little bit, 217. Although I think in Minneapolis, I think we saw them down just a little bit. And down about 7.7 for the last 12 months. How about just for Feb? Yeah, so Feb down about 8%. Let's see, anything else here? You guys are all feeling pretty good? I guess I'll take that as a positive, or else it's just a really shy group. Let's take a look in chat. So what is the condo market? Yeah. Oh, Jeff, I didn't know Jeff was on here. Hey, Jeff. Yeah, the condo market is definitely telling us that it's changing and that it is definitely undergoing a shift. Now, let me say, I do not believe it's dying. In fact, I'm convinced it's not. I think there's been a disruption. I think we're already starting to see some things change. And actually, as long as we're kind of geeking out about this, let's just do another second. Let's see, pending sales over the last 12 months. How about just the last month? You guys, look at this. Let's do our bar chart here. Look at pending sales, signed contracts in the region. Single family down 2.25%, townhomes down 1%, condo signed contracts up 32%. So the answer is no. People have not abandoned this segment, right? They just haven't. We're seeing demand starting to come back. Whether that's hit the closing table, yeah, some of it has. Are they taking a little bit longer to sell? Yes, they are. Right. So you guys kind of see how things look. Let's see. Bill made a comment. Could kind of be a result of some overbuilding. I think so. I think a year and a half ago, we were complaining quite a bit about, people were complaining quite a bit about, oh shoot, Legacy. Legacy was what? The only new condo tower downtown. And now I know we're doing 11. And I think that's all, what, 900K plus, million plus. So, I know a lot of that activity has kind of been centered, around here. And now I think 11 is going, isn't it going right here by Red Cross? So this is Legacy here. And we couldn't build them fast enough, right? We couldn't build them fast enough. We just kept putting them up. And then we still had conversions, right, over here in the North Loop. Right, we still had conversions going on in the warehouse district, and we were still putting up new, new product over here in the Mill District in downtown East. Let's see what else. Oh, Bill's comment also kind of made me think. Multifamily, you guys, multifamily rentals. As we see a buyer frenzy, as they're motivated by a need for more space. Millennials are having kids. Some of them are having twins. I don't know who, but they need a little bit more space. So multifamily rentals, especially, I believe, have been overbuilt. And I think you're starting to see rents starting to contract a little bit on that multifamily side. Julie says, the inventory shortage is making me sad. When will buyers get more breathing room? It's the $1 million question, right? It's the $1 million question. And I just don't have an answer. I think we'll have to look and see what happens with forbearances. And as we come out of forbearance, if some people, feel the need to sell for whatever reason, I think we'll have to watch that. I think later this year, if some people put off a move, whatever, a move up, a move down. I think Jeff made the comment, condos are the link for us old folks to find homes. And it's not just condos, townhomes, you guys. Single level living, townhomes, master, kitchen, right, bath, all on the same level for some of our aging backs and aging knees, and we just don't have that kind of product. So of course, our baby boomers are feeling a little bit stuck in their single family homes. You know, they're probably paid off. All you got is taxes and insurance. Well, guess what? I mean, sometimes it can be one person living in a 3,000 square foot, 4 or 5 bedroom home. You're supposed to free that up so that you can move up or over on the housing ladder, and then someone else can come in and occupy that product. And that's just not what we see happening, because the gears have sort of rusted and seized up a little bit. Now I'm just playing with Google Earth here, so forgive me. What else, guys? Is that, you guys feel pretty good? I know we're a little bit over here. What are we, 13 minutes over? So if we're ready to call it, I will be sure to have even more fun content for you guys next time.
All
And
right,
with
we're gonna
that-
go ahead and end the webinar for all. This was recorded, so we'll go ahead and get this out to everyone. And I did have a call come through. David, do you send out your slides to people or?
Yes, yep, we
Okay.
will.
All right, so you can expect that too.
Awesome. Thanks, everyone. Thanks so much for joining us.
All right, everyone. Everybody have a good week. Bye.
See you next time.